Welcome, everyone. My guest today is lead analyst Logan Mohtashami to talk about the big drop in mortgage rates following Friday's job report. Logan, welcome back to the podcast.
Wow. Wow. Whoa. I always get up really early for Jobs Friday. And we talked about this, about how there's going to be some hurricane issues and that, because the run rate is so high that unemployment rates are going to rise for the next, 12 months, especially if you have a misprint. But when that jobs report came out and the 10-year yield, which has already had a kind of a noticeable dive, took a waterfall dive right to that 380 level, all the messages were like, oh, he was right. The Fed won't pivot until the labor market breaks. So we're going to have to talk about this in a more constructive format because everyone thinks the labor market is breaking for the Fed. The Fed might think something else, but as we could all see, they're old and slow on this one.
They are. Okay, so we are recording this obviously on Friday, August 2nd. Even on Thursday, August 1st, we saw mortgage rates reach the lowest level at that point that they had all year. And then today they're going even lower. So walk us through
Sarah Wheeler, the first thing is who's going to buy American bonds? America's broke. Who's going to buy? We have 35 trillion in debt. Everyone has multiple jobs. We're a poor country. Who's ever going to buy the 10-year yield at 5%?
That's you being sarcastic, answering someone who just yesterday put that on was it Twitter or
Rookie
Instagram?
Ball.
I don't remember.
Rookie ball. That's all I'm saying. In any case, let's go back to 2022. Somebody spiked the Fed's eggnog. We're like, wait a second. I was like, this is not, something changed here. So for those of you that are new here, we have a lot of new followers. The whole premise was that the Fed is going to not pivot until the labor market breaks or jobless claims gets to 323 or the market gets ahead of them. So what's occurring right now is what we've always talked about. The labor market has been deteriorating for months. This is six months ago. But the Fed is going to hold everything until the very last second. But the 10-year yield, not old and slow, 10-year yield will just get ahead of them because they have twice already. They've tried. But back in 2022 and 2023, the labor market wasn't breaking like we're seeing in the data now. So just because of what the Fed's meeting was this week, and then the jobs report came in, the unemployment rate went up. The labor force growth is about 1.3 million more. So that's why you could have the unemployment rate rise while the jobs are still being created. But boy, did they box themselves in now, and just like the last podcast, you could see Powell is like, skittish Toombs. Your crew looks skittish. That's what I was thinking about the Fed. Boy, your man looks skittish up there. So the labor market isn't breaking like the Fed would think it is. Already Barkin has come out, one of the Fed presidents, like 114,000 jobs is a pretty good number. I don't know if I'm going to say anything about a rate cut. Shh. Just seriously. They're so old. Oh my God, I want ball players. I want the Fed to be ball players, but it's frustrating. I get it. But for everyone in the mortgage and real estate industry, remember, all we care really about is that 10-year yield going down, because that's what's really going to. What's happening is the spreads have gotten better. Today the spreads were the best in a very long time. So you're seeing rates starting to pick up on the downside. Imagine what we would call the double. We've been saying this for all year long. Imagine the double whammy effect, because we're having a little bit of it right now. The rates are acting better this year than last year, so the rates are naturally lower, even with the 10-year yield not as low. So we're getting to that stage. It's, can we get the Fed to come along and just stop this nonsense and just land the plane and not screw this up? So that's the thing. I think a lot of people just say, "Oh my God, you're right. The Fed didn't pivot because they didn't cut. Now the unemployment rate's up, and they're like, oh my God, the labor market." In their mind, they don't see the labor market breaking. They just see the labor force growth is picking up. There is a hurricane impact in this jobs report. The run rate needs about, which means you need 250 to 300,000 jobs to keep the unemployment rate at bay. And wait a second, the unemployment rate went up higher than they thought. So I think we have people already like doing 50 basis point rate cuts in the next meeting, already pricing that in. Boy, it escalated quickly, didn't it, Sarah?
It really did. So what will change the Fed's mind? From where we are now, what is the pivot point for them?
The 10-year yield is doing a lot of the heavy lifting for them early on, but I've always said that they've highlighted jobless claims, and Chairman Powell even said it. Jobless claims are still low historically, so I just hope they don't wait until 323,000. Because the unemployment rates is picking up. And I understand the labor force growth is growing. There's 1.3 million more people. So naturally the unemployment rate can rise with jobs being created. So it's not like a job loss recession, but you're starting to lose the narrative where the country is going to just not basically understand what you're talking about. All they see is the unemployment rate rising. All they see is interest rates are really high. And then everyone thinks you're behind the curve. And when you get an entire country looking at you that way, and whatever your first 5 minutes of every Fed presser talks about, it just looks a little bit more disingenuous. So I will reserve my judgment because really, Sarah, you know me, I would love to just come here and just bash them to obliterates right now and say, I told you guys so. They weren't going to do anything until the labor market. But there's a chance. And I know the Minneapolis Fed and the San Francisco Fed staffers are listening to this. And we've always said this, get your crew on board. Don't let the marketplace, the labor market wasn't breaking in 2022 and 2023, but your own data lines are deteriorating right in front of your eyes. Okay. And when Jerome Powell said, well, if there is a recession, it's not in our hands. That's not a good enough answer. If you don't want the job, give it to me. I'm ready to play ball. I am not some soft old guy that's going to say 1970s inflation might come. So it's just we've seen what happened. We're basically right at that point, the 380 level on the 10-year yield. The labor market has gotten noticeably softer from January. So the ball's in their court. You guys, it's your choice now. And you could see why Dudley was like, they need to cut rates now, not before September, you see. And I just feel the pain that everyone on Twitter finance, everyone's like, what are you waiting for? What are you waiting for? And I said, guys, this was always the plan. The Fed really wanted to deteriorate the labor market because confidence, Sarah. We need confidence in inflation. Inflation growth rate has been like tame for some while. We need confidence because if the labor market breaks, we could just say our dual mandate and we have cover. Oh, that's soft. Oh, that is softball right there. Waiting to get cover instead of making a choice. So if that's how you guys want to roll, that's fine. That's on you. But I never bought that confidence line whatsoever.
So from the beginning, you've said the pivot happens when we have 323,000 jobless claims. Is that right?
Yes.
And where are we right now?
That we should, jobless claims are rising. The 4-week moving average is not at not above 250,000. But what's happening is that the marketplace is getting ahead of the Fed. And because job openings are deteriorating, because the unemployment rates are rising, it's putting more pressure on the Fed to get something done earlier. Like now it's like, what are they going to keep on saying? Unemployment rate goes to 4.5%, 4.6%. The country doesn't care about its labor force growth is growing. All they see is the unemployment rates rising and you're keeping the Fed funds rate up. And then if a job loss recession happens, oh, by the way, where's Neil Kashkari today? I put a picture of his face on Twitter. I was like, where's Neil? Where's this? My gut's telling me the labor market is tight. Unemployment rate should, maybe increase a little bit. Gut was wrong. So I'm just hoping they just take from that stage and go, okay, we pushed it. We pushed it to the limit. Logan was right. We were going to push it to the limit. Now let's just get on to the next stage. And you're going to need to have housing come back. If you want to prevent a recession, we've seen it in the data line in every single recession. Construction workers lose their job, residential. It has not happened yet. You can change this. You have the power, right? You can do this. It's if you're willing and committed to. And I just don't know. I had a really bad feeling in 2022 about what they were changing because I picked up on some of the key terms they used back then, and now we can see it. So I understand all those messages I got. Oh, you were right. The Fed didn't pivot. No, in their minds, they still haven't seen the labor market break yet because they've really focused on jobless claims. And they say the unemployment rate is historically low, but it's a bad look, man. It was not the best week for the Fed.
It's been rough. So, if you're in mortgage real estate, rates help you when they go low, but only if they stay low for some period of time so that your consumers can make some plans around this. So can you talk to me here about like what you see the 10-year doing as far as like, is it bouncing? What are we doing?
No, this is the downward trend. So for all of you that are here listening to the podcast that follow me on Instagram, you guys all know this. We wanted that downtrend to stick, and it's been sticking, and now it's had a waterfall dive. So you can make a case short term, the bond market is overbought, but man, we've really had a big rate move. We've already now had a 1% plus move lower from the recent highs on mortgage rates. So to have a sustained housing market, what we've seen in the past few decades is usually we get mortgage rates to fall 2% lower, 2% plus lower, and just stay in that range. So make it very easy, like 4.5 to 5.75, something like that would actually, and just stay there, not going back up to 7 or 8 or something. So then everyone can make choices, because this is not like buying something on Instagram or something. The whole process of housing is like a year before, you just don't jump up and go. So considering how hawkish the Fed has been and how tight the policy, thankfully bond traders are not old and slow and they got ahead of them. And America isn't broke. People bought our bonds. Jeez.
Okay, so we've talked about very recently how if those two things come together, if you've got the bond market getting ahead of the Fed and the spreads getting better, and then the Fed lowering the Fed funds rate, that we could get below 6. But what you just said was from 4 something to 5.75. So how likely is it that we get in that, low 5?
Sarah, last podcast we had, we said you said that the MBA had a 6.5% forecast. Yep. Okay, one of the quotes we had today was 640. So I'm telling you this: you cannot sit there and put a forecast and come back 2 months later. You got to track the 10-year yield and what drives it, because it's the slow dance. Yep. Woo, the slow dance between the 10-year yield. So now the 10-year yield has dropped. What's next? We got this 380 line is going to be a pest. But if the labor market starts to deteriorate more and more, guess what we're going to? Sarah, we might get to the Gandalf line. Okay, the Gandalf line at 3.37. And the difference now is that if we get to the Gandalf line at 3.37, which really needs the labor market to deteriorate even more, and then the Fed to just flip and pivot and you get easily with normal spreads 5.25, not a problem. I mean, if spreads were normal today, you're at 5.5. You're even a little bit lower than that. So we're at key technical levels here on the 10-year yield, and but I mean, we can get there, especially if the spreads. And again, the Fed could change all this. Sarah, they could just 1 or 2 sentences. It's choice, right? When I say they have a COVID-19 housing economic policy, it is choice. This was the whole intention: keep home sales depressed as everything, get construction workers to lose their jobs, not make any comments about housing. You haven't seen anything about housing, like anything positive for it. And then the labor market, and then all of a sudden they're going to go, oh my God, we didn't see it coming, Sarah Wheeler. We've done these cycles for 6 decades, and for some reason we missed it again. But again, labor data runs the show. Paper, rock, scissors, we've always said. Labor over inflation, labor over Fed rate cuts, right? This is our line. Guess what happened? The labor market just overrammed, the Federal
The
Reserve on
problem
this.
is we only get labor data like once a month. I mean,
Nope,
when it
that's
comes
not.
to this
Nope.
part.
Jobless
Well,
claims are
okay, all right.
weekly.
So the
Jobless
weekly jobless claims,
weekly
right?
jobless claims. So again, it's not like we're losing 400,000 jobs per month or anything. So I really want to just come here and just bash the Fed, but I'm giving an olive branch. Fed staffers, get them all. But listen, if you want me to, I'll come to the Fed president's things and talk. I can do this, right? There's no old and slow here. We play ball. But you're going to have to be careful because the country is seeing the unemployment rate going up and the Fed not, and then everybody says you're behind the curve. And then everybody's saying, look, all these people are saying cut rates. Credit card delinquencies are up, auto loan delinquencies, all these things. It just has a bad look now. 2022, there was no recession. We weren't breaking yet. 2023, no, we're not there. But this is not that cycle. We're not that period anymore. The labor data that you have told us all to focus on has been deteriorating. So the ball's in your court. Olive branch, you can change. You don't have to be this way. The anti-central bank people, those people are crazy, right? They think we're broke and everyone, whatever. They're going to go to this with their grave. But you, as Fed presidents, can change. Okay, so I'm just hoping, right?
Yeah.
I'm just hoping you guys, it's not too late.
Well, this is good news for everyone in the housing industry, right? Just seeing the bond market do this, seeing mortgage rates go down. The fingers crossed part is like, let it have some duration. Let it have some duration.
You need duration. Yeah, I mean that's been the problem the last 2 years. Whenever rates fall, remember when Neil Kashkari said, "I don't like it. Mortgage rates are down to 6%. How are we supposed to balance the economy if people are buying homes?" I mean, it's not that stage anymore. So I'm going to reserve judgment. I'm going to see, okay, they're all going to have a weekend to sit and think about it now, right? And then what they say now, and every Fed president talk, because they never shut up, what they say now to the marketplace really matters. So every Fed president, when you do a speech talk, you adjust your speeches. Fed staffers adjust their speeches. Even if they tell you not to, you go in there and change the speech. Okay. Sometimes the young have to come in there to help the old out. All right. Get them to come on, move.
So if you're in mortgage and you've got people who are in your pipeline, what do you do right now? What are you calling them on the phone, being like, let's do this, let's lock? Do you wait till next week? Like, what does that look like?
I'm going to put my loan officer hat back on, and I am calling every single person and saying, I've been like playing this song, "We Ready," that football song. You got to get people ready, right? Because if it happens, if rates keep on going lower and your people aren't set, if they're looking to buy and they go, okay, let us know when mortgage rates are falling, and they're not ready, then guess what? The other people. So you got to get people prepped up. And I've always said, give them payment levels. Tell them, listen, what rate payment level are you going to be comfortable with? Okay, and then you say, okay, rates have to come here, home prices, whatever. Give them something so when it goes, you get them ready, because other people aren't going to wait. Millions and millions of people buy homes every single year. They're ready. So make sure your clients are ready, and they're all seeing the headlines too, right? Rates are going low. Rates at 2024 lows. If this keeps on happening, right, early bird gets the worm in that sense. So that's all you can do for people now with qualified mortgage. If people don't qualify, it's not going to happen. But I think the more important thing now is everybody is trying to get the Fed to just get to the other side. And I would have loved to just sit here and go, I told you guys they didn't pivot. The labor market's breaking. Okay, but in my mind, I know what they're thinking. They're thinking, oh, are they still creating jobs and jobless claims are low? And that's not the way to look at it at this stage. So positive. All these things are positive for housing, because housing has been depressed, third calendar year of the lowest home sales ever. And just for everyone to kind of realize this, everybody says, well, there's a recession going to come, right? Who's going to buy a house during a recession? Remember COVID-19 recovery model, April 7th, 2020. All of a sudden, people are like, Logan, why are you bullish that people are going to buy homes? And I say, you explain to me, what do you think is going to happen? They're like, well, there's 20 to 30 million people unemployed and there's 5 billion in forbearance. Cute, all good. Look at the army behind me. I got 133 million people. I got 133 million people with 3% mortgage rates. We're running this. We're going to run this show right now. We're going to run over everyone. Now it's a little bit different. Now we have 162 million people. I'll take the non-farm payroll and the other 20%. We got 162 million people. Now rates aren't at 3%, but you're going to have the largest workforce ever in history with the lowest level of sales ever in history. And it doesn't take much to move the needle. So a hypothetical, assume that the recession starts, we get a couple of bad reports, a couple 100,000 people lose their job, rates go even lower. That army is massive. It's like 160 million versus your 2 million. Who do you think is going to win? So that's how people should look at it. And this is why, even during the tech recession, home sales kept on rising as rates go lower. Now, the tech recession, there was only 2.4 million people that lost their jobs. But here, the unaffordability is a better counter to my take that their mortgage rates aren't going to get low enough. The Fed's not going to be dovish enough to really grow sales with duration. But that first bounce is going to happen, right? There's just simply not enough people losing their jobs with the amount of people working that can benefit. And when you're working from such low levels, you get that. And we saw this late 2022, even late 2023. But now, boy, if we could get lower rates, like what I told CNBC early this year, you really need like 4.75 to 5.8 to if you really wanted to grow sales. You can get better demand heading down towards 6%, but if you really wanted to grow sales, you got to get there. And how do we know this? Is that's kind of what the builders have done. The builders have been able to grow sales just because they can get rates down to those levels. So again, because sales are so depressed, so low right now, it's going to be interesting. Like we said, it's going to be interesting second half of 2024, but oh my, 2025. Woo. Oh my, 2025 is going to be interesting.
And we will mark down August 1st and 2nd. This when it started to happen. Logan, thank you so much for being on. We will talk again soon.
Pleasure, Sarah.